Good morning, everyone. Welcome to the New York City Retirement System's Common Investment Meeting for January 25th, 2018. I just want to welcome members of the public here and remind you that we start with public session, and then at a certain point we're going to move into executive session, at which point we'll be asking you to leave the room. Okay, we're going to start by, let me just say, for the schedule, folks, remember that we'll go through public session, then we have executive session up here, then we'll break for lunch and reconvene in caucus downstairs in the various caucus rooms. Okay, so we're going to start with roll calls. Let's start with the fire department roll call. Who's going to call the roll of fire? Pat? Thank you. Patrick Dunn.
For the mayor?
John Adler here.
For the controllers, Scott
Here.
For the commissioner of finance?
Here, Cynthia Collins.
For the we got Cynthia for, okay, John. For finance?
Oh, we just did finance.
All right, sorry about that. For the UFA, we got Gerard Fitzgerald.
Gerard Fitzgerald here.
UFA, Leroy McGinnis.
Leroy McGinnis here.
For the UFA, Mr. Edward Brown.
Leroy McGinnis with Edward Brown's proxy.
UFA, John Kelly.
John Kelly for the UFA.
And for the UFA, Thomas Fish.
Here.
For the UFOA, Mr. Jack Kelty.
John Farina has Jack Helty's proxy.
Okay, and for the UFOA, Mr. Farina.
Mr. Farina is present.
For the UFOA, Mr. Paul Mannix.
Here.
And for the fire commissioner, we have a quorum.
Thank you, Pat. I just want to acknowledge before we move on to the other systems that this meeting will be Tommy Phelan's last meeting for the fire department pension fund. And personally, I just want to acknowledge Tommy's been a great trustee, has spent many years serving the pilots in the UFOA and the entire fire department pension fund. So thank you, Tommy.
Thank you, John. Thank you. I appreciate that, and I appreciate all you do for us.
Okay, let's move to the police pension fund. Kevin Holleran.
Representing the PBA, Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, and John Puglisi.
Merritt Riley from the PBA.
Representing the DEA, SBA, sorry,
Gary DeRosa, designee for Ed Mullins.
LBA,
Lou Turgo.
CEA, Commissioner of Finance,
Cynthia Collins.
Mayor's Office,
John Adler representing Mayor Bill de Blasio.
Comptroller,
John Dorsa, representing Control, Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg for Police Commissioner O'Neill.
You got a quorum?
We have a quorum.
Thank you, Kevin. Okay, moving on to NICERS. Melanie? John Adler, present.
Public Advocate's Office, Letitia James. Here. Borough President Manhattan, Mr. Baldwin Bonillo. Present. Borough President Brooklyn,
Present.
Mr. Andrew Bernardis. Borough President Bronx, Mr. Raymond Sanchez. Borough President Queens. Okay. Borough President Staten Island, Isaac Gorodetsky. Present. International Brotherhood of Teamsters, Ms.
Present.
Okay. Transport Workers Union, Mr. David Katzman.
Here.
District Council 37, Ms. Robin Roach. Raymond Santander.
Ray Santander for Henry Garrido.
Okay.
Okay, we have quorum.
We have a quorum.
Thank you. And I think we can do the teachers' retirement system right now. Patricia?
John Adler,
Present.
Thomas Brown, David Kazansky, Raymond Orlando, Deborah Penny, Susanna Vickers.
John Dorsa for the Control's Office.
We do have a quorum.
Thank you. And Board of Education retirement system, Sandy?
Mr. Adler, we're represented today by the trustee Isaac Cavagnani. We do not have a quorum. We'll administer these resolutions at our next formal board meeting. Thank you.
Thank you. Thank you very much. Okay, so we're all duly counted and accounted for, present and accounted for. Let me just remind folks to please say your names when you start speaking so our a stenographer can keep accurate notes of the meeting. Okay, with that, we'll move into our first agenda item, which is the Mercer, and I think Jimmy Yan is going to lead us.
John, are there handouts for the Mercer presentation?
Jimmy, are there
Yes.
handouts?
Yes, you received materials in your earlier. There are two reports that Mercer submitted, a climate risk assessment report and a climate strategy report. And I think you might also have the PowerPoint.
He's asking if there's...
No, there are no additional
no
handouts,
paper.
no. Everything's in your convene. If anyone else can, okay. So Jimmy Yan from BAM. Today, Mercer will be presenting their final presentation to NYSERS, police, fire, and BRRS in helping the systems evaluate the potential risks and impacts of climate change on our portfolios. Mercer work includes a best practice review of peer pension funds, an overview of options on whether and how to integrate climate change investment risk in the areas of investment policy, asset allocation, manager selection, and risk management. It also includes an overview of prudent investment strategies to assess the risks and opportunities created by climate change. So as a reminder, Mercer presented its first report to the boards at the November CIM, and that was a best practice review and explanation of their approach to climate change scenario analysis. Today, Mercer will present two reports that you received in your materials. The first is a climate risk assessment, one for each system. This discusses potential risks of climate change under different scenarios, different climate change scenarios for the systems. And the second report is a climate strategy report, which outlines a broad set of investment-related actions that the boards can consider to continue to assess and address the potential risks of climate change. So that's the overview. With that, I'll turn it over to, so we'll have two lead presenters from Mercer. And I'll turn it over to Alex Bernhardt, and we'll have one on teleconference.
All right. Can you hear us, Jane?
Yes. Hi. Good morning, everyone.
Excellent.
Good morning.
It's like the Oscars.
Good morning.
The Oscar goes to...
All right, Jane. So we've got the first slide, the agenda slide up now here.
Okay. Fantastic. Great. Well, nice to see you all this morning. Alex and I have an action-packed agenda here to take you through and look forward to presenting our results and also having a good discussion. So I'm going to take us through the first couple of slides, which will do a little bit of a recap of you. Found
Lost her.
through the methodology and the key findings. And we're going to then allow some time for questions and discussion, and then we'll move into the final section around developing a climate change strategy. So if we look at the next slide, we have an overview. As Jimmy said, we were here a few months ago presenting the results of the best practice review. Since then, we've really taken a deep dive into the different asset allocation of each of the systems, done the risk and performance assessment that we'll be presenting today, as well as the recommendations around the strategy options that we're putting forward to you. So that's really kind of the final step of this project. So just to take a bit of a look backwards, on the next slide, we see the key findings that we had from the review of 8 of your peers. So these include and international who have already taken a kind of robust look at climate. Now we see here on this kind of heat map that the most progress has really been made in terms of articulating investment beliefs and processes, and really more work is happening now at the portfolio level. And there really are a couple of kind of key points we can take away from this that are really relevant for your discussions today. One, to address climate risk, right, and on the individual circumstances of each fund, your governance strategy, your investment portfolios, and the shared perspectives of the different individuals involved. Most of the leading funds have been working on this topic for a number of years. And of course, through the work of the corporate governance team, your organizations have also done a lot of great and leading work that's been internationally recognized. There has often been less progress, or progress has been a little bit slower where external managers are involved. Now, that's a kind of natural finding because, aligning one organization is hard enough, but aligning multiple stakeholders and service providers takes time and quite a lot of effort, to be frank. So that's just a reality, I think, that's ahead of you. But the good news is that where you have shared ambition and enthusiasm to make progress among board members and the investment staff and the investment team, that's really proven to be a very critical element in success for the organizations that we review. Now, the other kind of key point we wanted to put forward in this discussion is the next slide, looking at the recommendations of the Financial Stability Board Task Force on Climate-Related Financial Disclosures. Now, we talked about this in November as well, and I know that Mike Garland also did an agenda item on this for the group. Now, the task force was established in 2015, and the original focus was really to look at company disclosure and what information is being provided to investors to inform their decision making and ensure an appropriate allocation of capital. But as the task force did its work, and I was one of the 30 plus members, we realized that by just increasing the supply of information to the market, without also trying to increase the demand for that information, we wouldn't really achieve the aim of promoting kind of well-informed capital allocation, promoting stable markets over time. And so for that reason, the recommendations also apply to asset managers and asset owners such as yourselves. Now, they're pretty straightforward in terms of looking at governance. So, who has oversight of climate-related risks and disclosures? Where is this documented? What is the strategy around this? Is it integrated into your investment, decision-making? Have you thought about the impact of different climate scenarios? And of course, now you have, as a result of having done this project together. From a risk management perspective, are you integrating climate into your existing risk management and reduction processes, including things like engaging with managers, engaging with companies, low carbon allocations? And what are you doing in terms of metrics and targets? Now, the carbon footprinting exercise, of course, helped you to kind of move towards that in terms of getting more information. But thinking about additional targets is also something that the task force recommendations encourage organizations to do. Now, the PRI does an annual reporting framework. So for NYSERS and TRS, who are PRI signatories, they have already received the request to include in this year's reporting some information that is aligned with the task force questions. So that's behind the scenes, a good kind of coordination, I think, between the TCFD and the PRI to try to facilitate, the ease of reporting. So I think the launch of these task force recommendations creates a framework for disclosure for investors, but I think also very importantly signals growing interest and focus by regulators around encouraging more focus on climate and more disclosure of those how those climate-related risks and opportunities are managed. So I think it's an important piece of kind of understanding where we are 2018, what is the kind of the backdrop against which this topic should be considered. So with that, Alex, I'll hand over to you for the next section.
Thanks. So I'm going to spend a few minutes talking about climate change risk assessment methodologies, so the two different methodologies that you guys have employed to understand climate change risk in your portfolios, and then I'll talk about the results of our analyses and also Trucost's prior analysis for your portfolios. when developing any investment risk management strategy, we feel, and I think it's generally accepted, that having as many risk assessment inputs as possible is very useful. Broadly speaking, there are two types of risk assessment that you can perform, both top-down and bottom-up. And top-down analyses include asset liability modeling or asset allocation modeling, manager due diligence, and bottom-up is looking at the holdings of specific managers, for instance, at the sector distributions of those holdings and at the specific risks embedded in some of those holdings. For this particular climate change risk project, you guys have developed, engaged us to conduct some top-down, scenario-based climate change risk assessment work, and you also engaged TrueCost to do some bottom-up carbon footprinting. And so I'm going to talk about the methodologies behind both of those risk assessment techniques, and then again the results. So first, starting with our climate change risk scenario methodology, I think it's important to understand the motivations that we had in developing this work. And we started analyzing climate change and its impact on investor portfolios way back in 2011. We issued probably our seminal report on the subject in 2015, and we've been evolving our thinking on this subject ever since. But what initially motivated us to look at this topic was, well, there were a number of factors, really. Primarily, what Mark Carney has coined, and Mark Carney is the governor of the Bank of England and the chair of the FSB task force on climate-related financial disclosures. He's called it the tragedy of horizons, which is the simple fact that climate change occurs over many decades, even out into the second half of this century. And we're not expecting the worst impacts of the physical impacts of climate change until the second half of the century. And investor time horizons are typically much shorter. Quarterly reviews, annual reviews, and sometimes long-term 3 to 10-year strategic reviews. And so we felt it was very important to develop a specific risk assessment approach at the total portfolio level, which would help to bridge that divide and look a little bit farther beyond typical investor timeframes, and again, try to bridge the time horizon divide. Additionally, we recognize that there are a number of different climate change scenarios which can take place. We don't know what the ultimate temperature trajectory is right now, and where we'll reach at the end of the century, and as such, markets cannot account for all of those scenarios, and so we felt it was important to provide a deterministic or scenario-based analytical methodology to help understand what the impact of those potential scenarios might be on portfolios. And so to develop our model, we developed a set of degree-aligned scenarios. We have a 2-degree, a 3-degree, and a 4-degree scenario. A 2-degree scenario, we're going to ignore the 3-degree scenario for our purposes here today because it's sort of the middling scenario. The 2 and the 4-degree scenarios have the most significant results on either side, and so we're going to focus on those. A 2-degree scenario is one in which there's strong political action to regulate the emission of greenhouse gases. There's strong technological innovation, which foments more disruption in, say, the energy market by investing more in renewable energy. And what we see in a 2-degree scenario is more transition risk. So the risk of disruption from transitioning to a low-carbon economy. On the other hand, a 4-degree scenario, one in which it's basically business as usual. There's limited coordinated policy action and limited investment in renewable technologies, say. We see much stronger physical climate impacts than we would see in a 2-degree scenario and much lower transition risks. And so that means that in the short term, a fragmentation scenario may be less disruptive to portfolios, and we'll see that in the results, which I'll present later. However, over the long term, it's an uncontrolled scenario. We don't know what's going to happen with the climate, and so it has a much more deleterious impact on the physical environment. So we defined specifically these scenarios and what they mean in a quantitative standpoint. And we also recognize that climate change isn't just one risk or even 2 risks. It's actually many risks. And so we developed a set of what we call our risk factors, or our TRIP risk factors, which are described here on this slide: technology, resource availability, impact of physical damages, and policy. Our transition risk factors are the 2 on the end, so technology and policy. And so again, the risk of technology relates to disruption to incumbent industries from from innovation in, say, the renewable energy sector or in low carbon or electric vehicles, say, causing incumbent industries to decline in value. Policy risk is similar in that government regulation, again, imposes caps on, say, greenhouse gas emissions or other related activities, again, causing disruption in the transition to a low carbon economy. The physical risks are focused on the weather impacts. Resource availability is really chronic weather, so the impact of long-term shifts in weather, precipitation or temperature over seasons or decades can cause resource impacts in the physical environment. And then there's also the issue of catastrophes. Climate change is having an increasing impact on extreme weather events, floods and hurricanes and the like, and as the frequency and severity of those types of events changes, we'll expect the impact of those events on the economy to increase, say, in a 4-degree scenario in particular. And so with each of these risk factors developed, we assigned sensitivities to each of the risk factors at the asset class level and also at the industry sector level. And this is an illustrative heat map of how those sensitivities apply, and they're various depending on the asset class and the industry sector under consideration. So what we did to apply this model is we took our existing asset allocation model, which we still run, and we run that on typical portfolios, and it creates the base case against which we're going to compare our climate models. And then when we want to understand the climate change impact on a portfolio, we'll run the base case, and then we'll run a secondary analysis with our climate change risk factors and the climate scenarios turned on. And those are simply applied on top of our existing asset allocation model, and it's the difference between that climate change scenario and the base case, which we highlight in the forthcoming slides. I also wanted to take a second and talk about carbon footprinting. So you saw a presentation. Okay. Hello, who's there? Okay. We saw a presentation from Trucost a couple of meetings ago, and I'll highlight again some of their key findings in a few slides. But I wanted to call out the importance and the usage of carbon data, as well as some of the potential drawbacks of carbon data as just a starting point, and to give some context for how you might actually implement or use the data that Trucost has provided you. So we think carbon data is very useful, especially in the development of a climate change risk management strategy, insofar as it's readily available, it's generally highly disclosed. A large majority of companies actually disclose their greenhouse gas emissions. It's also a relatively simple measure of owned emissions and gives a clear indication of relative exposure versus benchmarks or versus other portfolios. It can also be used to monitor progress, say, towards a decarbonization target, as some of your peers have adopted. And it also can be a useful tool for developing engagement strategies, say, identifying companies which are leaders or laggards in specific industry sectors and which might need a prod to improve their practices. On the other side, carbon data has some drawbacks as well. It's not typically an audited disclosure. The gaps in the disclosure landscape, in order to fill those gaps, there's some estimation methodologies need to be used, and those are various. Perhaps most glaringly, some carbon data rarely includes what are called Scope 3 emissions, which is effectively the downstream impact of a company's products. And those, in many cases, especially in the instance of energy, can be be most impactful from a potential carbon emissions standpoint. And so all this means that while the data is very useful and important to have for a climate change risk management strategy, it should be viewed with these caveats in mind, that it's not generally applicable and the answer for climate change risk. It does have some caveats applied to it.
What? I'm sorry.
Yes, go ahead.
Joe Alejandro again. What was that again? Was it phase 3 you said?
Scope 3.
Scope 3. Okay.
Yeah.
And that's the one that uses some sort of subjectivity in actually coming up with an estimate.
For sure, yeah.
Now, how much of subjectivity? Is it a lot?
It's a lot. Well, so the numbers that you received from TrueCost, and which I'll present in a moment, were only Scope 1 and 2. So they didn't include Scope 3 emissions. And that's in part because there's so much variance and uncertainty in exactly what those values are that they're not typically included in carbon analyses.
So how much of the report actually has Scope 3 estimations in it?
None.
None? Okay. Thank you, John, for answering that. Appreciate that. Seems others have seen the report before others, so thank you. All right. I just.
This was the report that we got several months ago, the True Cost report that was presented to all of us.
No, I'm just referring to the 42-page report I received yesterday in the email.
No, I only got that yesterday as well, Joe.
Yeah. That's the more in-depth report, so that's the concern I had. Okay?
Yeah, that was background data.
It's still data, so we
Correct.
don't know which data will be important to a decision maker. Thank you.
Cool. So unless there's any other questions about the methodology, I'm going to talk about the results that we came up with using our scenario analysis and also a review of the TrueCost results. So I have here a sample fund results at the total portfolio level and at the asset class level, which I'll highlight for a 2-degree scenario and a 4-degree scenario over the next 10 years, so a 10-year time horizon. On the left-hand side, you see the 2-degree scenario output, and on the right-hand side is the 4-degree scenario. So a quick refresher on how to interpret these circle charts. They're very pretty, but they can be hard to understand without a primer. So in short, the black circle represents the entirety of the portfolio. And the full length around is 100%, and then the width of each colored bar is the size of the allocation to the asset class. And so U.S. large cap equity in this case is about 25%. And then the direction of the circle, of the colored bar into or out of the circle indicates whether it's negatively impacted by this climate change scenario or positively impacted by this climate change scenario. And moving inside the circle is a negative value and outside is a positive value. So you can quickly see which asset classes are driving losses and which are driving gains in the portfolio in these scenarios. So overall, for this particular portfolio, we'd expect the return in a 2-degree scenario to be 6.59% or so. And if you compare that portfolio outcome versus the base case, which is, again, our asset allocation model run with our asset allocation model run without climate change considered, we get a 27 basis point average annual return drag. And you may say, well, what does that mean in dollar terms? And so we've done our best to translate that in a simplistic way to a dollar amount. And so that equates to about a $2.7 billion loss on a starting value of $57 billion over that 10-year time frame. And that's a very simple linear extrapolation of that average annual loss impact, but it gives you a sense of the magnitude. And so the 2-degree scenario is definitely the worst, has the worst impact on this portfolio versus the 4-degree scenario. A 4-degree scenario, you can see that there are much fewer squares or bars that go into the circle, and that the ones that do go into the circle are less severely going into the circle. And so overall, the portfolio return in this scenario is expected to be 6.75%, which is about 10 basis points off of the base case, or a $1.1 billion cumulative loss. What I'll highlight here is that in a 2-degree scenario, you have asset class winners and losers, right? There are the developed market equities exposure really drives the downside in that 2-degree scenario. But on the upside, you've got some real asset classes and emerging markets showing a positive return impact in a 2-degree scenario. So those partially offset the loss in developed market equities. Whereas in a 4-degree scenario, you can see that there are no asset class winners. All the asset classes experience a loss. And so that means that the asset class level, anyway, you have fewer risk management tools at your disposal in a 4-degree scenario. So questions about how to interpret the circle charts before I move on to the other key findings of the report?
Yeah.
Oh, go ahead.
So Aldrin, representing the Manhattan Borough President. So it's a little bit counterintuitive, right? So the 4-degree scenario is a fragmentation scenario, and the 10-year horizon is applicable to both the 2-degree and 4-degree scenario.
They're equivalent.
But the portfolio returns will be higher in the 4-degree scenario because it's the 10-year time frame that we're looking at.
Yeah.
But if we looked at a 20-year, 30-year time frame, then that's when we would see the impacts of the fragmentation.
That's a great point. And so as we move out in time horizon, if we get, we modeled 10-year and out to 2050, so a little bit over 30 years for this particular report. You can see that the difference between a 2-degree and a 4-degree scenario starts to narrow significantly once you get towards 2050. And our expectation is if we were to continue our model to 2100, say, the 4-degree scenario would be much worse. That's intuitive, right? But yes, so we see that in our results is that the outcomes of a 2-degree and a 4-degree scenario get closer out towards 2050. And so it's primarily an issue of time horizon. And so overall, our findings are that across the funds that we modeled, since they have very similar asset allocations, and this is an asset allocation level analysis, our results are pretty broadly similar across the funds. A 2-degree scenario has the most significant negative impact on each portfolio across both horizons, the 10-year and to 2050. Again, that difference in return impacts narrows out to 2050, and we would expect a 4-degree scenario to be much more deleterious as time goes on. At the asset class level, it's important to recognize, as you saw in the circle charts, that asset class impacts can be material in either direction. The asset classes which really seem to drive the impacts at the portfolio level are developed market equities. Those are pretty much universally negative regardless of the scenario, in large part due to significant exposure to carbon-intensive or fossil fuel industries. And then we also see emerging market equities and real assets having a wide range of impacts. So in a 2-degree scenario, we expect those asset classes to be positively affected, and in a 4-degree scenario, we expect them to be negatively affected. So there's a lot of variability around performance and relative to climate change for those particular asset classes, which warrants particular care in determining a risk management strategy. So I'll also go over the Trucost results here again shortly. This is a slide from their deck, which they presented a couple of months ago. Broadly speaking, the fund's portfolios are in line with their benchmarks. It's nominally below, but effectively equivalent to the benchmarks in terms of carbon intensity, which is fine. That is a fine result. If you dig into the portfolios, you can see what's really driving the current level of carbon intensity in each. The materials sector, in all cases, contributes negatively to the carbon footprint of each portfolio. And so some additional focus on the materials sector might be warranted if decarbonization or lowering the carbon footprint of the portfolio becomes a goal. And then in all cases, the top 10 holdings contribute about 20% to the total carbon intensity of each portfolio, which means that there's an opportunity, if you really concentrate on those top 10 holdings, to significantly diminish your exposure to carbon-intensive industries if you engage with them or if you choose to diminish your exposure to those companies in some way or another. And most of those companies are in the utilities sector, or in the energy sector. And also importantly, of those companies in the top 10, most of them are laggards compared to their peers. And so Trucost provided in their report a ranking of each of the top 10 companies versus their peers in each sector, and most of them fell in the bottom half or even lower in the sort of distribution of peers in each sector. So that means that there's definitely room for those companies to improve their practices around carbon. So with that, I'm going to turn it over to Jane to give us, unless there are more questions about the risk assessment methodology and the results, I'm turning it over to Jane to talk a bit about our recommendations. Seeing no questions?
Okay, fantastic. I'm sure we'll have some more questions as we go through the recommendations. Okay, so if we can pull up the slides again. Really, before we get into the recommendations, we thought it would be helpful to touch on the why and the how, kind of as the background towards how we're thinking about the strategy and why we're putting forward these recommendations. So the why, I mean, there's a couple of key elements here that you see on the slide. I mean, the first really is that climate-related risks and opportunities are likely to be significant regardless of which scenario unfolds. And therefore, it's in your best interest to be prepared and to think about the different potential options and impacts on your portfolio and optimal ways to think about repositioning. Another key point is that, regardless of the extent to which we see physical climate impacts, of course, there is still scientific uncertainty about exactly how that will unfold. The reality is that we do see regulatory and market actions causing disruption today. There have been some 1,200 different climate-related laws that have been introduced in different jurisdictions, and that's on a steep upward trend, and we continue to expect to continue to see that unfold with more new additional laws and requirements being introduced around the world in different markets. And we also see different kind of market actions and economic realities unfold. We've seen big changes in areas like electric vehicles. We know that half of new power installed has been renewable for the last few years. So there are some significant changes that we're seeing that will continue regardless of the exact path around physical climate impacts and the science behind that. Another opportunity for long-term investors such as yourselves is really to be able to take a step back and think about the tragedy of horizons that Alex talked about, and really kind of capitalize on your long-term investment outlook and perspective. And then the last point is the fact that there isn't market certainty around exactly what climate scenario will unfold, and therefore some market pricing or mispricing that investors can also think about and look to take advantage of. And this relates to mismatches in the time horizon across the whole range of market participants. They aren't all long-term investors that are given this topic as much thought as you are. The reality that the future won't exactly mirror the past. I mean, there's a lot of investment practice that is focused on, looking at long-term historical trends. And from that perspective, climate can be a challenge. We know that there is a relatively low rate of adoption of kind of a strong climate strategy across the market as a whole. We see that among the larger organizations, but not so much among, the thousands of smaller and mid-sized market participants. And there is, of course, uncertainty around the specific climate scenario that we will see. So together, these realities, I think, are really good motivation for, the why of developing a climate strategy, and the how, I think really relates to a number of building blocks that this project has hopefully delivered to you. So one of those is thinking about industry best practice and what, we can all learn from how large investors are taking action on this topic. Another is the specific information that we've uncovered through doing the portfolio assessment and looking at areas of specific vulnerability in your portfolios. And then finally, thinking about things really as helping to provide kind of shape and consistency around how investors can address this topic. So on the next slide, we also just wanted to touch on the framework within which we've put forward the recommendations and the detail behind those, which are in the strategy document that you received last week. So a number of years ago, we published something called the Mercer Framework for Sustainable Growth. It applies to climate, but to any ESG issues. And really, we strongly encourage investors to take 3 steps towards developing that, and really starting with the beliefs. Debating, discussing, thinking about an issue, and then articulating your belief around that issue, and then having that influence your investment process. So, your governance, your documentation, and, how you think about working with service providers, and then getting into the portfolio and thinking about, what do those beliefs and processes mean in terms of how we can, optimally reflect our position on certain issues at the portfolio level. And if you jump into the portfolio too quickly without establishing from a governance perspective some of those other elements, we find, investors can kind of go in circles and not be able to make concrete process. So it does make sense to go through the process by step. Now, on the next slide, we have our specific recommendations to you. So there is one in the belief column, which is that your organizations develop one or more investment beliefs specifically around climate and document those. Now, in the strategy report that we delivered, you'll see that we actually put forward a number of potential belief statements that you can consider to try to help to, kind of kickstart that process. And they really span a range of potential positions from kind of more limited conviction on certain issues towards stronger conviction. And they cover both kind of the perspective on risk and fiduciary duty, as well as the specifics around, integrating climate considerations into investments, making sustainability-themed investments, making divestment or decarbonization decisions, and also around engagement. So we've worked with other organizations where, those belief statements have been specifically, reviewed or debated or surveyed. And, doing that work, I think, really can put you in a good place in terms of, having a common framework for making additional decisions. The next column goes through the process part, and this is the longest list. There are 8 specific recommendations here. Some of them are easier than others. So the first one really is to also develop some specific language in your investment policy statements around climate and climate risk management. Now, exactly what that language looks like, of course, relates to your beliefs and your specific approach, but documenting that is important. And we also recommend that, developing even if it's kind of a short, crisp climate change strategy document would be an advantageous thing for you to do in terms of, having on one piece of paper your perspective and your approach and your expectations, so that can be shared with your external managers, with your consultants, with your stakeholders, to clearly communicate what your perspective and your strategy is around climate. The next 2 recommendations relate to the corporate governance group and really are about kind of clarifying more than doing anything differently. So the first is around clarifying the expectations that you have for companies that you're engaging with in regards to alignment with the Paris Agreement and the task force recommendations. And second is to document the policy that you have around advocating for reasonable climate-related policies and regulations across jurisdictions. So that is, relating to the different investor statements that have been reviewed and supported in different instances. The next recommendation is around risk management. So adopting a reference to climate-related risks in the overall risk management framework. And we, in the report, have some specific items that relate either to managing transition risk as well as to physical risk, and some specific kind of elements that could go in there. But, thinking about doing a kind of annual review of the carbon footprint and, thinking about including that in as one of the ways that you monitor investment managers and communicate with them would be one specific element that would fall in there. And then speaking of managers, the next recommendation is to really conduct a more kind of robust review of all external managers, both kind of communicating your expectations, but also, figuring out kind of where they stand on this issue. And in our report, we've included a number of specific qualitative and quantitative questions that you could consider including in that review. And I think undertaking that process would be some work, but it would give you some really good information to really understand, your starting point, the perspectives of different managers, and it would also give you a framework for including a, review of climate as part of the due diligence element of exploring any new additional managers that you're considering in the future. The next point is around using the PRI assessment framework questions that you've received recently for NYSERS and TRS, who are PRI signatories, to take the opportunity to report on the TCFD related questions that are included in those. And then the final one also relates to reporting, and a recommendation that you should think about doing an annual report against your climate change strategy, if you formally adopt one, or even if you don't articulate a formal strategy as a standalone element, to do a around all of the different pieces that relate to climate, because there is a lot to think about. It's not just around investing in one specific technology or avoiding one specific type of investment. It really is much broader than that from our perspective. And then the next 4 recommendations are at the portfolio level. So the first one will really relate to the investment beliefs which are developed and the strength of those beliefs and the view that they take. But our recommendation in that context is to think about expanding the current divestment to consider high-cost, high-carbon reserve owners, as well as thermal coal-powered utilities. The second recommendation is around moving a portion of existing market cap passive equities towards an ESG or a low-carbon alternative. You look with little cost and tracking error to kind of move a portion of the portfolio towards a lower carbon alternative. And then the third recommendation is to target an aggregate allocation of 1% towards sustainability-themed investments. So now this could be deployed across different asset classes wherever you can find attractive investment opportunities. And over the next 2 years is really how we were thinking about the recommendations. So to have that be a target by 2020. And then the last recommendation relates to that sustainability target. In the context of achieving that, we would recommend that you kind of re-examine some of the existing limitations on private equity investments, particularly in 2 areas. One, about considering smaller funds. Given this is kind of an emerging and growing area, there are some smaller funds that may not typically be on your radar screen that could be worthy of consideration. And then the other element would be broadening the horizons a little bit to emerging market investments on the private equity side, where again, we think there could be attractive opportunities for capital deployment, and certainly also a need for capital from a climate perspective around the sustainability-themed investing approach. So the next slide shows you all of these same recommendations, but plotted out from a couple of different perspectives. So there's a color coding here, which is a little bit much to look at perhaps, but the line around the circle shows you where it's a yellow line, the items which are already underway. And that's really the 4 at the top, the 4 green circles around engagement, which you're already doing. And then at the bottom center, you see divestment of thermal coal, which is a commitment that you've already made. So the other colors are around the beliefs, process, and portfolio framework that I just talked through. So you can see based on the color whether it's a beliefs, process, or portfolio item. Now, where these are placed on the chart relates to 2 things. So on the left-hand side, we can see the impact on the climate. Now, this is, we've kind of categorized as either being direct or indirect. So the direct impact would be the elements of, the climate strategy, which have the more likelihood of having a direct impact either on the real economy or on the level of emissions. So we can see here some of the engagement activity and filing of resolutions, which could directly shift corporate behavior and government behavior, as well as some of the allocations to sustainable private assets in the pink bubbles through the middle are more likely to have kind of a direct impact on emissions and the energy systems. Whereas we also see a number of elements around the bottom which have more of an indirect impact. So if you're looking at a low carbon passive index fund, or you're trading out of securities that are in public markets, those activities are having a less direct impact specifically on emissions. Now on the bottom, see the additional kind of cost and disruption to the existing investment process. Of course, this is another important consideration when you're developing this type of a strategy. Some of these things are easier to do if we look at, allocating to a low carbon, index fund, or shifting your index fund to a different one, participating in some of the collaborative engagements with policymakers where, it may be reviewing and supporting different letters and statements. Those are relatively straightforward items. Whereas if we look at the right-hand side, and integrating climate into your manager selection and monitoring. So undertaking that kind of full kind of survey and review of all of your external managers, getting that information back, assessing it, figuring it out what it means, looking at some of these direct allocations. These are things which are going to take more time and energy and resource really to implement. So of course that's another important element to consider. But really, when we look across the full kind of scatter chart here, we see that the strategy recommendations that we're putting forward are relatively diverse in terms of things that will have both direct and indirect impacts, and have relatively light and more significant resourcing implications for your organizations. Now, the fuller strategy document that you received has a little bit more background on each of these steps. And hopefully some helpful information which will be able to enable you to implement and act on them in a relatively straightforward way. They all are very much framed in the context of your role as fiduciaries who have an obligation to make sure that the pension payments that you're responsible for delivering get to the right people over the right time frame, and really thinking about climate as a key investment risk and also as an opportunity is very much the perspective that we've taken in developing these recommendations. So the final slide, really, again, coming back to Mark Carney, who Alex talked about earlier, the whole point of this exercise, our recommendations to you, were to help you to invest with foresight in a changing world. And by doing so, hopefully allow you to regret less in hindsight. So with that, I'm happy to open it up to questions and discussion.
Thank you. This is Roy Richter, and it's a lot of information you just threw out there. And but I got from it that there's a lot of maybe really positive things, but it's really expensive. Is that what that slide said? Like more time, effort, resources, drain on resources. This is like an expensive thing to actually implement.
I can take a first crack at that, Alex. You can weigh in.
Okay.
I think that the expensive part certainly relates to time and effort from BAM, and they'll have to clearly consider the prioritization around some of these points. A lot of them don't necessarily have a direct cost in terms of looking at the overall basis point cost of running the fund. So I think it is around prioritization and resourcing more than necessarily direct cost.
So when isn't it you? I think one of the slides make reference to investing into like carbon efficient index funds and that type of things. I know that BAM has done a lot of work over the years in reducing our overall expense ratio with our index funds. So we would basically have to move to another type of investment that wouldn't necessarily have the same low expense ratio that we currently pay. Is that accurate?
We need to do a thorough review of the index marketplace, and I think today it's safe to say that a lot of these specialty indices do charge a little bit more in terms of basis points. But you guys are of a big enough size that you might be able to command, appropriate discounts or parity in some way or another. But yeah, that needs to be determined through further due diligence. And as with all of these issues, any investment issue, you need to make sure that your conviction in the outcome outweighs the cost. The conviction in the benefit of the outcome, I should say, outweighs the cost.
Mr. Garrido, and let the record reflect that Henry Garrido has arrived.
Good morning. My question is about the comments you made about the regulations and the changes. You said there are about 1,400 or so regulations affecting it. And I'm wondering how much of that is weighted between federal regulation and local regulations in cities and municipalities as opposed to the federal government implementing them.
I can take that, Jane. There's a report that I think it's the Sabin Center at Columbia put out, which was what Jane was citing, and we can send you that link, but it has a lot of the detail on that.
how much of an influence does that happen as the world begins to change and regulations begin to implement, over that 10-year period?
I mean, it really depends on the strength of those regulations and the breadth of them from a jurisdictional standpoint. I mean, it's a very mixed bag as to what those regulations stipulate. Very few of them are actually firm caps on or prices on carbon. Many of them are related to disclosure, but nevertheless, we're seeing much more regulatory focus on climate change issues, and so we'd expect globally this issue to become more regulated and legislated against.
If you can send me that report, I'd love to see
Sure,
it.
sure.
Thank you.
We can send that. I'll send it to our contacts. Yeah.
I'm sorry.
Ms. James.
Thank you. To what extent have we been effective in regards to engaging with these companies on climate issues?
Who are you?
Mike Garland, Controller's Office. In the last 2 minutes, I received an email from my staff who just withdrew a proposal from AK Steel, one of the highest emitting companies in our portfolio, which in response to a proposal from the 5 funds has agreed to set quantitative GHG emission reduction goals. It's a really good example of, I think, meaningful impact on our portfolio companies through engagement. And we're working collaboratively with other investors on the Climate Action 100 to try and take that to a global level and have a greater impact.
My second question is, we looked at the 10-year projections on 2C and the 4C scenarios. Why wasn't there a discussion on the 3C scenarios?
We didn't find that it showed anything different. It's in between the 2 scenarios in terms of impact and results, and so there are details on that scenario in the full reports that you received.
Okay. Third question. Why wasn't there any discussion with respect to litigation against some of these fossil fuels? Is that part of the analysis?
It wasn't specifically part of our remit, but so no.
Okay. And the last question is, can you talk a little bit about the Paris Agreement and the analysis that was done with respect to this, your recommendations?
The Paris Agreement? Jane, do you want to try and take that one, or did you hear the question?
I just heard the part talking a little bit about the Paris Agreement.
Yes.
Yep. How did that play into our recommendations? Yeah.
Sure. I think one of the really fascinating things about the Paris Agreement, and it was the 21st time that the Conference of the Parties came together to try to negotiate a climate agreement, right? So it took 21 years to make that progress. And the reason, or one of the key reasons it was successful, is because of the involvement of what the UN call non-state actors. And that is all of the investors like you and the companies that were involved and the cities and the states who negotiated behind the scenes, who came to Paris, who were very involved in the process. And I think that helped to not only achieve the agreement, but it also gives more confidence for the likelihood of the agreement actually being implemented. And I think one of the really good examples of that is the United States, where federal perspective, there's been less support for the Paris Agreement, but at the same time, you've had the launch of America's Pledge and the We're Still In coalition, who the same group of non-state actors have come forward and said, you know what, we'll pick this up. We are going to ensure that we meet the Paris Agreement, predictions and commitments that were made by the United States, and we'll pay the UN fees. And so I think that it is an interesting reflection of the fact that 70% of emissions come from cities, for example. So having mayors on board, having states actively participating is critical to a long-term shift in the emissions trajectory. And that is something that has been highly organized behind the scenes and continues to be rolled out. That's I think a very important reality and difference and shift, post that led up to, COP21 and still exists in the marketplace that investors really need to take into consideration.
Thank you.
So, I'm sorry, John.
Mr. Alejandro,
Thank you.
Officer Alejandro.
Thank you. So I just have 2 questions, 21 parts each now. So to the extent that, and I know I see the Paris Accord, but these non-state actors, had they jumped out at the very beginning, would not have a meaningful impact in the ultimate result of having some sort of accord that everybody agreed on to do something. And that's always been my issue with attempts to divest. There's varied opinions about that in this room. So if we divest in 5 years, 4 years, 3 years, it may change the dynamic ultimately where, some other actors out there can pick up these assets and continue investing in them years on into the future, maybe making significant result to their portfolios. That's, again, an opinion I have. And so, but my main question is this. To the extent that these, I guess, model that you have, that it relies on human behavior, again, you're going to have people maybe changing legal constructs out there, maybe people personally, their behavior, things of that nature. To the extent that this model has to be rely on human behavior, how wide can this model change? Are you sticking to, typical, I don't know, I don't deal with the model, but a mom and pop, who are at home and, doing certain things? Or is it, how wide the human behavior are you relying on in your model? Because that could significantly change the results one way or another.
I mean, I'll start, and Jane, if you have else to add, please do. But I mean, there's a lot we don't know about climate change and about the trajectory that we're headed towards, and it's for that reason why we developed a scenario-based approach, and also why we didn't assign probabilities to the specific scenarios, because we don't know which one is most likely to occur. It's a judgment call that each board, each trustee will have to make.
That's my concern. Mm-hmm. The judgment call in the so-called modeling, and I get that you have to sometimes make that kind of assumption in order to make the model work somehow, right, and make it meaningful to some people who are interested in it.
But generally speaking, that we think our 2-degree scenario is aligned with, I mean, there are many different ways you can get to 2 degrees, mm-hmm, and there could be different ways than the ones that we've envisioned. But generally speaking, the impacts, the relative impacts, we expect to be fairly stable, irrespective of the trajectory.
But human behavior is never that doesn't operate like that. It's never steady.
Of course not. No, right. Of course not.
It reacts to every little possibility out there, and there's millions of results that could occur.
For sure.
So that was the main. It's the subjectivity that goes into the modeling, in some sense, in some areas where, in order to make the model work, and I understand that that happens even when you're doing portfolio analysis. You have to rely on certain.
Yep.
Okay.
Yeah, as with any model, right? It's a guide. It's not the rule book, right? It's
right. Okay. Yeah. All right. Thank you.
Mm-hmm.
Other questions? Yes, Mr. Katzman.
Good morning. During the past few weeks, right, we've had a lot of language about fossil fuel reserves. I can't help but notice in the documents, Mercer is a little bit more cautious and speaks in such terms as high intensity, high cost fossil fuel reserves. In light of this, I found it interesting to note that in the breakdown of industry sectors, there are differences in the performance of different fossil fuels, or the risk factors of different fossil fuels. That, for instance, in the TRIP analysis, oil bears a striking resemblance to coal regarding the risk factors, whereas natural gas looks more like transportation and infrastructure. Similarly, I find that in the projections of climate impact on return by industry, that the possible impact, and, you know, the possible impact on the underperformance of coal is something like 5% per annum. With oil, something like 4% per annum underperformance, pretty close to coal. Whereas with gas, it is negligible. Am I correct in reading this one?
Yeah, everything you've said has sounded correct to me, yeah.
Okay, so some of these things are not like the others.
Correct. Well, I mean, fair enough.
Not all fossil fuels.
Yes.
Other questions? I just have one. I don't know if you guys saw, and if folks around the table saw the column in yesterday's New York Times by Eduardo Porter that basically posits that everything that has been happening on climate change to date, including the Paris Agreement, is essentially ineffective for the task. That it's all about voluntary participation and cajoling and so on, but without some real sticks, that it's unlikely that we're going to have any real effect on stopping climate change, and that in the last 25 or 30 years since these diplomatic efforts began, the climate has continued to warm, right? 16 of the 17 warmest years on record, or 16 of the last 17 years have been the hottest years on record in the Earth, and so on. And so my question is, I feel like the sort of strategies that are laid out here are the same ilk, the same category of cajoling, and whether it's engagement or divestment or low carbon investing and so on, they're really strategies to try to, influence companies that are contributing to climate change that are in our portfolio, to influence them to try to stop doing so. And my question is, and you guys may not have thought about this, but are there sort of out-of-the-box ways that we could invest such that we are, we are investing consistent with our fiduciary duty, but really trying to spur beyond cajoling and influencing and complying with the voluntary Paris Agreement, to try to lead the way in helping to stop the activities that are contributing to climate change. You know what I mean?
Jane, you want to take a first crack and I can add on, or?
Yeah, sure. I mean, it's a great question, right? And I know that, many of you are there thinking about this issue with a couple of hats on, right? I mean, first and foremost, you're there as fiduciaries, and you need to think about the portfolio and the investments, managing for risk and looking for opportunity. And I think, many of you also are thinking about it as, kind of stakeholders in the global planet and global economy, and how longer term we want to protect both of those things. And, limiting global warming to 2 degrees or lower is a really good way to do that, right? So in our Mercer study that we published in 2015, we talked about investors as future takers or future makers. So we're all future takers, right? We're all going to be impacted by whatever happens, and you can either be aware or unaware. So the more aware you can be, the better, you can take well-informed decisions to protect the downside impact on your portfolio. And so many of our recommendations are in that ilk. We saw that both the 2-degree and the 4-degree scenarios, our methods aren't perfect, but they're directional in terms of looking at the impact. Both of those scenarios have a drag on returns for your funds, right? So, as fiduciaries, we encourage you to think about taking steps to minimize those drags. Now, the second group of kind of investors, and there is a growing number of those, are these future makers who say, look, I'm not only going to think about my portfolio, I'm going to think about the global economy, which is going to drive my long-term portfolio returns. and, develop and articulate my belief that limiting global warming in line with the Paris Agreement is better for my ability to pay, long-term pensions, and also create a world that, my members want to retire into. And with those two perspectives, I'm going to influence which scenario comes to pass. Now, what is the best way to do that? Our view is it's a combination of engaging, not just with companies, also with policymakers, kind of out there in the open and also behind the scenes. You guys are already doing a lot of that. You have a world-class team. Of course, you could, give more resource to that group and they can do more in that area.
Mike Garland fainted, by the way.
And then, investing in solutions. We've put forward a 1% target. That is what Christiana Figueres, who led the Paris Agreement, negotiations, she has put out a challenge to all investors to allocate 1% of their portfolio. I think that was partly determined by the fact that 1% is achievable. Of course, you could do more, and you could allocate money to, new technology solutions, to, sustainable infrastructure deployment in emerging markets where it's incredibly needed. There's a lot more that you could do. We've tried to position our recommendations to have some of that stretch and some of that future maker perspective, but be really grounded also in kind of what's achievable in the current, the nature of your portfolios and staffing, et cetera.
Thank you. Thank you, Jane. Okay, Alex and Jane, thank you both for coming in and making this presentation. Oh, there's one more question? Oh, I'm sorry. Mr. Gordetsky.
Yeah, the question's a little bit moot after John asked his, but I do want to just ask, it seems like that top left quadrant is really appealing. If we were to pursue the top left quadrant of direct impact and low cost, are we losing out on, effectively mitigating the climate risk there, or is that a way to go?
Can you pull up the slides again, whoever is controlling that? There we go.
It's there it is, yeah.
So, you're right to identify that quadrant. It's the lowest effort and the highest impact on the climate. And yes, that may be the area that you want to concentrate on in terms of near-term activity because it involves the least disruption and cost and the most potential impact. But yeah, that requires some effort on prioritization of our recommendations, which you guys should take back individually.
Thank
you. Mm-hmm.
Okay, did I miss anyone else? Great. Okay, Mercer folks, Jane and Alex, thanks very much for coming in, and thanks for your work on this study for us. Okay.
Great. Thanks, everyone.
We're going to move to the next item on the agenda, which is the resolution regarding New York City Pension Fund's divestment exclusion strategy for fossil fuel reserve owners, and I'm going to hand it over to Controller Stringer.
Well, good morning, everybody, and I want to thank Jane, Alex, and Mercer for their hard work and diligence, and I want to thank all of the trustees. I also want to shout out the world-class team we have in the Controller's office, because Mercer did it, so congratulations, Michael Garland. So I'm going to get right to the point. On behalf of Mayor de Blasio and myself, I am here to submit for your consideration a resolution that aims to take immediate action to directly look at fiduciary options for divesting from fossil fuels. And I'm going to read the resolution into the record and ask that you consider it. Whereas the issue of climate change is already having and will continue to have a profound impact on our society and economy, current and future changes in risk, regulations, and attitudes towards the use of fossil fuels should be taken into account as we evaluate our investment portfolio. And whereas it is important for us as fiduciaries to consider the various ways we should assess and mitigate the risks that different sectors and industries have from the impacts of climate change, the long-term transition to a less carbon-intensive economy, and the potential for fossil fuel reserves and companies to lose a substantial portion of their value. And where the board has taken action to address the risks of climate change for our portfolio, including integrating environmental, social, and governance factors in investment decisions, and taking leadership in actively engaging portfolio companies to reduce their carbon footprint. And whereas the board has completed a carbon footprint analysis of our public equity assets, an assessment of potential climate change investment risks to our portfolio, and a review of approaches to integrating climate change risks and opportunities in our asset allocation, manager selection, and risk management. And these assessments and reviews have demonstrated that it would be in the interest of the system and its beneficiaries to consider additional prudent investment actions that protect our portfolio from potential impacts of climate change and prepare it for a transition to a low-carbon economy. And be it resolved that the board will initiate a process for determining a prudent divestment and exclusion strategy for fossil fuel reserve owners that responsibly reduces our portfolio's exposure to carbon risk and mitigates financial risks resulting from climate change consistent with our fiduciary duty. And be it resolved that in order to protect the long-term interests of our beneficiaries and determine the most effective way to safeguard our portfolio from the economic risks of climate change, the board will utilize an investment consultant to assist the board in determining prudent steps to divest and exclude from our portfolio the securities issued by fossil fuel reserve owners, including evaluating the anticipated impacts on risk and return characteristics of the portfolio, and seek legal opinion to determine whether any divestment plan and actions by the board fulfills the board's fiduciary duty to beneficiaries. I respectfully move this resolution.
Okay, the controller has moved the resolution. I think what we're going to do is we're going to see if there are seconds and actually have the fund-by-fund discussion of the resolution in each of the caucuses after lunch, but we will open it up for general discussion here if there are any comments that people want to make for the body as a whole, or if there are any questions for the maker of the motion. Ms. James.
So I second the controller's motion. As fiduciaries, I know that we all take very seriously our responsibility to protect the hard-earned money of hundreds of thousands of New Yorkers. And that entails ensuring that we invest in financially sound vehicles, but it also entails divesting from investments that are risky, subject to significant volatility, or greatly threaten human lives. Today, New York is taking a large step towards ensuring that our city funds are protected by calling for a study to analyze divestment from fossil fuel companies. And I recognize that this decision is not being made lightly. In fact, it's already required months of thorough studies to understand the carbon impact of our holdings. And today's resolution is a call for an even more in-depth analysis to determine a prudent divestment and exclusion strategy. And that means ensuring we understand the cost of this process, as well as what alternative investments may look like and how to rebalance funds appropriately to ensure a sufficient return on investment. But we cannot ignore reality. We are seeing significant threats to our homes, our economy, even to our city, and to our future as a whole. Threats that are only perpetuated by dependence on fossil fuels. So doing nothing and continuing business as usual is not an option. Fossil fuels are the single largest contributor to greenhouse gas emissions that have resulted in rising sea levels, more frequent and intense storms, the spread of new diseases, and much more. The realities are undeniable, and so is our contribution as investors in these companies. And fossil fuel companies are also facing risk. They are the subject of countless lawsuits and investigations, and in fact, 9 American cities have filed lawsuits against fossil fuel companies for their role in climate change, and ExxonMobil is being sued by their own employees for making false and misleading statements about the financial risk of climate change. But there are also risks subject to other risks. As the world moves forward with Paris Agreement, with the Paris Accord, these companies could face regulatory risk for noncompliance. And as we see more and more demand for renewable energy and clean alternatives, the actual value of our once profitable holdings in fossil fuel companies will be diminished. And the effects of climate change will have negative impacts on other holdings, the food companies we invest in, the real estate companies we invest in, both of which will impact our bottom line. And so it really begs the question, is it prudent to continue investing in companies that are susceptible to volatility and causing such widespread harm? And that is why I've called for a divestment several months ago, and why I'm pleased that my colleagues and fellow trustees, the Mayor de Blasio, and the Controller, Scott Stringer, have joined me in this call. The facts are undeniable, and our vulnerability increases every day we go without action. So I urge my fellow trustees to vote in favor of this resolution, and I hope that we would rebalance or reinvest in something which I've been calling for a number of years, and that is residential housing, workforce housing, affordable housing, supportive housing, housing, period. Housing which is LEED certified. We owe it to the thousands of hardworking New Yorkers who have put their savings and trust in all of us, and at this time we have an opportunity to provide benefits to New Yorkers who are struggling in the city of New York, and to provide them and to address their felt needs. I thank you, and I thank you for this opportunity.
Thank you.
Sorry,
Other
Facilitator?
yeah.
Officer
Alejandro.
Yes. I appreciate all the work that's been done, but the resolution has not only a request to adopt a strategy to divest, but it's also talking about a potential process. I don't, in the process being that, to hire an investment consultant, so I don't know what that means, what power, what authority the investment consultant will have. Each fund has their own investment consultant. And so I don't know how that would work out. And then it talks about legal opinion, who will give that legal opinion to the boards, how that process will be set up to make sure that it is a prudent, proper process for each particular board to do these things, given their own risk strategies. Each board has their own risk strategy. So the point here is I need a little bit more information, and I don't think the resolution provides that. So I need a little more layering, icing on the cake here, if that is so.
So can I? No. So I think those are very important comments. The reason the resolution is presented as is because we actually need to hear from a variety of experts and stakeholders, including investment professionals, academics, economists, scientists, activists, and concerned citizens. So, Alejandro, what we're starting out doing is we're going to issue an RFI, because that's going to inform our RFP as part of our search for the right consultant to determine a final strategy. And we are doing this with all of the trustees together. We're not moving forward without a thorough discussion. We want to hear from you so we could actually set up a process that works. This is not about speechifying. This is actually about doing the hard work, the work of fiduciaries, to deal with an issue that many people feel is critical to our portfolio and also critical to the planet. And I don't think they're mutually exclusive, but I do think it requires us to all come together on this. So I want to assure you from the Controller's Office, from Scott Evans, that we are going to involve and work on this together. Second, in terms of legal opinion, that is something we do as a matter of course, as you may remember, and we actually work with the law department as we go forward on these issues. So again, we want to make sure that we are approaching this from a proper legal perspective. We want to involve the trustees. And look, I personally want to get to the bottom of this. And I think this is going to be a very significant RFP, perhaps the most significant RFP we've had in a very long time. And we're going to work, and first RFI and then RFP. And I think it's going to be a lot of work, and I'm looking forward to engaging with all of you on this issue, and we're ready to sit down and have this conversation. I urge you pass this resolution to begin that conversation and setting that up.
Additional comments? Mr. Garrido.
So good morning again. I rise in full support of this resolution, and I want to thank the controller and the mayor and the leadership, and certainly our public advocate for taking the lead on this issue. I think it was Albert Einstein who once said that the insanity can be defined as doing the same thing over and over again, expecting different results. For us to continue to invest in fossil fuels the way we're doing, it is, to me, the quintessential definition of insanity. It is time to call the question on fossil fuels. And I have learned throughout my life that leadership is doing, it's about doing what's right, not doing what's safe. And I am full support of this resolution, and I urge my fellow trustees to support it and approve it as well. Thank you.
Other comments or questions? Okay. Yeah. Okay. So I think that concludes our public session business. Oh, I just want to note for the record that Raymond Sanchez from the Bronx Borough President has been here. Are there any other trustees who have arrived since we did roll call? We acknowledge.
Jack Kelty, Fire.
Okay, Jack Kelty, Fire. Okay. What's that? I couldn't hear that. She got it. Okay. Okay. Okay, so now I think motions would be in order for each board to enter executive session. Let's start with teachers. Is there a motion at teachers to enter executive session?
So moved.
Is there a second?
Second.
Great. Any discussion? All in favor of the motion at the teachers board to enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Okay, motion carries. Let's do NYSERS. Is there a motion at the NYSERS board to enter executive session?
So moved.
So moved.
Okay, is there a second?
Second.
Okay. Motion made and seconded. Any discussion? All in favor of the motion to enter executive session at NYSERS, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Next, let's do police. Is there a motion at the police board to enter executive session?
Motion to go into executive
Actually,
session.
before the motion, just a question. Is there any investment performance that we're getting today?
No, it's not
No
on the agenda
investment
today. We do it at the quarterly. Okay.
Ah.
Okay. So did I hear a
Motion's
motion to enter executive session?
Motion's been made.
Is there a second?
Second.
Okay, thank you. Any discussion? All in favor of the motion to enter executive session at police, please say aye. All opposed, please say nay. Any abstentions? Motion carries. And at fire, is there a motion to enter executive session?
So moved.
Is there a second?
Second.
Second. Motion made and seconded. Any discussion? All in favor of the motion at fire to enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Okay, motion carries at fire. Okay, we are now in executive session at all the boards. Let's turn the cameras off, and I would ask the members.
Cameras on. Thank you. So we've just entered into public session in order to discuss an item that was presented in the public session of today's meeting. And before us, we have a resolution regarding the New York City Fund's divestment and exclusion strategy for fossil fuel reserve owners. I guess the highlights and the things that I'd like to say about this is this action would be a first step. And an important step, but a first step in order to understand whether or not how this would play out for the police pension fund. Simply put, what we're really trying to get through in this initial stage is an RFI, a type of engagement that would allow for the flow of information and ideas from academics, experts in the field, economists, on different paths that could actually even be pursued in order to understand these issues. It's not it doesn't lead to a divestment tomorrow. That's not the goal of the initial steps. It's to gather information and understand exactly what we're looking at. We've heard a lot of information from True Cost and Mercer, and they did very interesting work. but this is really to build upon that, get a free flow of ideas. This is an undertaking that few, if any, large plans have really been able to do, and I think we owe it to the members to at least explore this, see if it's something that is viable. If we get the results back and don't feel that it's something that would work for the police pension fund, that would be one thing, but I don't think we can make that judgment without knowing what is actually out there. And I think that the process would allow for a free flow of ideas. We may get people that have very strong feelings in one direction, and we might get people that from the academic community and the economist community that are completely opposite of those. And I think that any of that information that we get would help us formulate, if the board so chose to go to the next step, which in my mind is actually issuing an RFP for services to have someone study certain things that we've uncovered in the RFI phase, then the board would have to take additional action to do that. And then ultimately, to act upon any recommendations from any provider we use through an RFI or an RFP, it still would require the board's action. So today's motion is really the initial step to ask the world for information. And by world, I mean I think that we're not limiting the requests that we would get to only the U.S. companies that are out there. I think there's a lot of providers in the world that may have some interesting ideas that they'd like to share with us or have us consider as we formulate an RFP. But I don't want there to be any thought that this is the first and only time that you'd be asked to take any action on a strategy. I think that this is really just putting it out there that we're interested in learning more and getting ideas. And without having any information, it's hard to make a decision to not go ahead and do something. And I think that as long as we have all the information, we can ultimately be in a position to make the best, to chart the best course for the police pension fund, for its members and beneficiaries, so that we have this perpetual plan last perpetually. And I don't know if anybody wants to add anything. I don't know if Cindy wants to add anything, or if any of the other trustees have anything that they'd like to add. But that's kind of how I'm framing this, if you will.
So if the resolution were not passed, then microphone.
I need to use a microphone.
If the resolution were not passed, BAM could not try to get that information on its own.
So BAM would be, so any of the systems that approve the RFI, if you will, BAM will go forth and ask for information. That's what they'll do.
From whom?
From the world that I just indicated. I think the hope is, because of the significance of what we're trying to look at, and in order to ensure that we get flow of information from a lot of different sources, we'd like to. We're hopeful that all the systems would want to participate, at least in the initial phase of information gathering. I don't see the harm in asking people for more info, and that's where I think we are on this.
So, John, I appreciate your words here. I appreciate the work that BAM has been putting into it. However, I feel it's the trustees are being asked to come in at the last minute and deal with this issue. My concern is that the resolution doesn't read like you're saying. There's nothing in there about an RFI. The process, if you see the resolve paragraphs in there, talks about a process that's still undefined within the resolution, which I have concerns about. I don't like to just assign my name to a resolution that is undescribed at the end. I don't have a process that's going to be helpful. There may be a lot of concern about global change and climate change, but I think at this point we have consultants here that can review our portfolio, let us know if there are problems. We've never even addressed this even in our investment principles, all right? And so the question was this something that these trustees on this fund are concerned about right now, I think that should have been done in our policy statement. It has not even been addressed there. So I don't know what the sudden urge to do this was, but I see that a lot of work was done without us being involved in the very beginning of it. And I have other concerns I'm not going to address. I'm not concerned about people's political tickets being punched in order to address this issue. There are other people who sit on other boards I'm not going to get involved with. But I think for us, we have a very good proxy group within BAM, and I think that's the location, that's the focus of our attention, to make sure that they're doing what they're supposed to be doing with these so-called bad actors that are out there, and I'm not even sure if they're bad actors yet. Our proxy group will be able to address some of that, given the shares that we have. So I think we have a mechanism capable of addressing this. I don't think I need another resolution with another undefined process being pushed by someone who may or may not be here 4 or 5 years from now, and I think that's my concern. And at this point, I am not prepared to vote for anything like this. Mm-hmm. Absolutely. So we're gonna take a second to caucus.
Yeah. If, Mikey, could you pause the camera, please? Sure. Thanks.
Possible return for our beneficiaries, which are our pensioners. And as I looked at the pros and the cons, and I'm definitely somebody that is very concerned about the environmental impact of a lot of large corporations and their carbon footprint that they leave on this world. And I'm a big believer that government should play an important role in that. But as you apply that to investments of almost a $40 billion police pension fund, and basically change your entire philosophy and your structure of the investments to make sure that you don't invest in certain companies for the sole purpose that they have a larger carbon footprint. And instead of having an impact on those companies through what we've done, I think the Comptroller's Office has done very successfully in the proxy committee, where they've actually, through our ownership and the shares that we own in the various big companies, and some of the big companies that you've identified both in the reports and some that have been spoken outside of this room, we've had a very tremendous impact on adopting philosophies that are more in the nature of good business, and good business equals a positive world environment and a negative carbon footprint. And I think, as the study showed, a lot of the companies that we invest in, we've had that impact, and the carbon footprint that the companies have is lower. That being said, I see a tremendous hazard with trying to pull out of certain companies, Fortune 50 companies, Fortune 100 companies, or across all lines of investment, to actually relinquish our ownership in those companies for the sole purpose that they have a large carbon footprint, or they're engaged in certain transactions which could have a negative impact on the environment. And I would much rather be more of the line of maintaining an ownership in that versus taking action that in some way would violate what I feel is my fiduciary responsibility to this fund by having a performance and a rate of return that makes sure that the pensions are paid in the future. So for those reasons, I'm not convinced that this recommendation is in the best interest of the fund.
If I can, Roy, I think we take our fiduciary duty with the utmost seriousness, and it's something we don't take lightly, that responsibility that we have to the beneficiaries and the members of this fund. I think, and this might just be a difference of opinion, I think putting on the fiduciary hat, it's incumbent on us to look at every avenue. And simply approving this does not say we're getting out of, or we are we don't want to invest in those 50 companies or 75 companies or 175 companies, whatever is identified. I think what this is doing is allowing us the opportunity to move forward in order to identify whether or not that is something feasible that could even be done. If it can't be done, I think the information would show that it's not something that's feasible. If it is something that's feasible, I think it'd be important to know how. And I think for those types of reasons, that's why the recommendation is not getting to a definitive answer. It's not saying that tomorrow we're taking this action. I think what it's doing is saying, before we start any journey, let's just, pack up the car and make sure we got enough gas to go. And I think of this, if you will, as packing up the car with information, going to the next stop, and seeing if you want to continue the journey or turn right around. So I think that we are acting as fiduciaries by putting forth the resolution, and I think we've done it in a thoughtful way that we can hopefully satisfy the goal of looking at every investment, looking at every option, making sure that we're attacking the problems accordingly, and making sure that at the end of the day, we are in fact looking out for the future of this plan. And like I said before, it's a perpetual plan, and it's our hope it will always be a perpetual plan. And I think the way to get there is to just be able to evaluate every situation. And the situation that's before us today is a question about whether or not climate's going to play a role in our ability to invest in the future.
I appreciate where you're coming from, and I, for the record, like to acknowledge that the Comptroller's Office is building off success. I think Mark Gartland has done a tremendous job, spearheading the proxy campaign. However, that being said, this resolution I see as something as more the nuclear option, and I would like to stay away from that nuclear button, as long as I can. And I just don't see that the ultimate goal. I shouldn't even say goal, or the pursuit of information that would lead you potentially to divestment, which I believe is a nuclear option, is in our fund's best interests. And it's just where I'm, where I'm coming from.
So you want a roll call vote?
So do we want to, so let me ask this question. Would we like to vote on this measure, or would you like to table the matter and see if there's either way to tighten up the resolution in order to I believe there was a comment about it being maybe too open. However you'd like to proceed, we're open. I think I could speak for the mayor as the co-joiner of the recommendation. That we'd be amenable to a table if people wanted to review the resolution a little bit further, or see if there was any issues that could change on that. If that is not something that the board is interested in, we could always call for a vote. I'll leave that up to the folks around the table.
Right. No, and I'd also say that even regardless of what the vote is today, I hope that we as a board could continue to engage in discussion and open discussion, which I hear from around the table. Everybody seems to be very open to perhaps talk about our investment beliefs and, and come to a consensus on the best way to move forward. I don't think that this is as Roy, as you said, I don't think that the discussion will end today, regardless of what the vote is. And I just encourage us to continue keeping an open dialogue and keeping all these issues on the table for our fiduciaries and for the, as fiduciaries for our fund beneficiaries. Because at the end of the day, that's why we're all here.
And again, I've heard all the points made regarding the resolution. I just think the best way to approach this is let the board have the discussion first whether this is something we even want to pursue. Before we're now at a resolution point, and again, whether it's a defined, I think it's an undefined process being stipulated in that resolution. But I think it's something that the board needs to discuss first, whether it wants to adopt a philosophy that will keep this type of careful investing in mind going forward with regards to the environment. And then after that, then we can start defining a potential process down the road. That's all.
So Joe, just what I would say is.
I just am uncomfortable with.
No, we can take a vote today on the resolution before us. I don't think that would prevent us in the future, as my colleague from the mayor's office indicated, of coming back. And if we do hit the next phase, which would be, after, presuming that some of the other systems decide to embark on an information gathering exercise, if we were to bring a next step to those boards, we would obviously welcome you joining if we choose to take next steps on this, and we'll keep you apprised of how it goes. So I think that I would request if we do vote.
Well, do you want to give us a few minutes just to, is there any, because it sounds like there's just some uncertainty and that there hasn't been enough time to really consider the resolution, if it would be more appropriate to have a table than a vote on this, on the resolution.
I'd rather vote now, today.
Okay, all right,
and-
that was my only question.
Yeah.
So I think if it's the wish of the board to vote, I would request a roll call vote.
Okay.
PBA?
PBA votes no.
DEA?
No.
SBA?
No.
LBA?
No.
CEA?
No.
Commissioner of Finance?
Yes,
Mayor's Office?
yes.
Controller?
Yes.
And the Police Commissioner?
Yes.
Okay, 6-6.
Okay. All right. So I make a motion.
Wait, we have to do the report out from
Yeah, that's
executive.
okay. I'm sorry.
During executive session, the trustees heard recommendations from the comptroller and the board's consultant, as well as saw presentations from managers in the following asset classes: private equity, infrastructure, and real estate. Decisions were made, details to be made public at the appropriate time.
Okay, John.
So that concludes the business of the police pension fund?
So motion to adjourn.
Second. Thank you.
All right.
Are you ready? Okay. We are back in public session. Melanie, would you please report out of executive session?
The trustees agreed to commit funds to a private equity investment, the details of which will be disclosed at a later date. The trustees agreed to commit funds to an infrastructure investment, the details of which will be disclosed at a later date. The trustees conditionally agreed to a real estate investment, the details of which will be disclosed at a later date. The trustees agreed to an interpretation of a 1998 tobacco resolution.
Thank you very much. Okay, we have one more item for discussion in public session, which is regarding the resolution regarding New York City Pension Fund's divestment and exclusion strategy for fossil fuel reserve owners, which the controller offered earlier today as a motion in our public session. So we need a second for that motion.
Second.
Okay, motion made and seconded. Okay, so is there discussion about this motion for a fossil fuel reserve divestment study?
Yes, there is.
Mr. Katzman.
At the risk of deja vu. All over again.
Very nice.
The general thrust of this resolution is to carry through a process by which we can reduce the carbon risk of our portfolio. However, I believe it is too narrowly cast in the resolved paragraphs. The controller mentioned earlier today plans to conduct an RFI followed by an RFP. The aim of an RFI is to cast a very wide net to gain valuable information to guide the formulation of an RFP. But the formulation is resolved paragraphs do not lend themselves to casting a wide net, but rather a narrow one. And rather than formulating them solely in terms of the securities issued by fossil fuel reserve owners, it would make more sense to formulate it in terms of our portfolio's exposure to carbon risk and specifically to the securities issued by fossil fuel reserve owners. In this way, an article can be formulated which looks very broadly at strategies for reducing carbon risk, which include but are not necessarily limited to reducing the exposure to fossil fuel reserves.
So, Dave, what are you suggesting regarding the resolution that has been moved?
Okay, I will propose an amendment.
Okay.
That in the first resolved paragraph, right, that in the first resolved paragraph, in place of a prudent divestment and exclusion strategy for fossil fuel owners, to substitute a prudent strategy that would responsibly reduce our portfolio's exposure to carbon risk, and specifically to the securities issued by fossil fuel reserve owners.
Can you repeat that? So it would say, so the resolve would read, be it resolved that the board will initiate a process for determining a prudent
strategy that would responsibly reduce our portfolio's exposure to carbon risk, and to carbon risk in general, and specifically to securities issued by fossil fuel reserve owners. And then continues as stated, and mitigates financial risks, et cetera, et cetera.
So, okay, so we would delete reduces our portfolio's exposure to carbon risk.
Beg your pardon?
Well, he's saying that he knows he would keep that. Instead, he's essentially taking he's taking out the words divestment and exclusion strategy for fossil fuel reserve owners.
Correct.
Instead, he's saying...
No, I know that, and then the sentence goes on to say, responsibly reduces our portfolio's exposure to carbon risk. He's just talking about carbon risk, so we need to delete that as well.
Right.
And go straight to mitigates financial risks resulting from climate change consistent with...
Put in something about fossil fuel reserve owners, and specifically to...
I think she got that. She got that part.
That's in the first part of the sentence.
No, it's not. In the second part of the sentence.
Can someone read back cleanly?
Let me see if I got it, Dave. Did you write it out?
Okay, I have half written that. Okay. I'll start with the be it resolved.
Yeah.
Okay, bill of speed. Be it resolved that the board will initiate a process for determining a prudent strategy that would responsibly reduce our portfolio's exposure to carbon risk
in
general, and specifically the securities issued by fossil fuel reserve owners, and mitigates financial risks resulting from climate change, consistent with our fiduciary duty.
So it really, yes, okay. You got that, Suzanne? So it
Yes.
really reverses the order.
Right, and deletes the words that I said. Or delete it.
So hold on for a second before you. So the first question is to the maker of the motion, is that a friendly amendment?
I think so. Yes.
Okay.
It's very good.
So we now have an amended motion. Would you further discussion or comments?
No, look, I would not have accepted, I did the language change, with all due respect to someone I have great esteem for and understanding. The title of this is a resolution regarding pension fund investment and exclusion strategy. I guess we can leave that and change the language, but at the end of the day, this, this could theoretically come back and, the analysis could be that we should add more fossil fuels. I mean, if you have an open mandate, where a sufficient number of folks have been researching and studying this. I give lots of credit, and the public advocate did today as well, to the mayor and to the controller for instituting this. We've been calling for this for a long period of time. I think at the end of the day, having clear instructions to the consultant, whoever that might be, and this part of the RFI process, which is hopefully will not take a long period of time studying the concept of a study, but that we can efficiently move ahead with it. What I want to see is I want a plan of what it would look like to divest quickly, so that we could say this is consistent with our fiduciary duties or it is not. Those of us who looked at this believe that there is that study that can be done, but as fiduciaries we have to wait to see it be the final result. To open this up as to other ways to lower the ultimate carbonization of our portfolio is not necessarily what, as trustees, I think we should be ordering our consultant, whomever that may be, or to the controller's office who will conduct the RFI process, so that there's a clear path to having an RFP issued so that we can have a consultant do this analysis, so we know how it affects our portfolio, both in risk and what the alternative investments are. So I don't think we need to water this down necessarily to suggest that divestment is not an outcome. That would be the end of a study conclusion. What we want to do is ask them to study this so they can present a feasible plan before us that we can make a prudent decision on.
Larry, thank you. If I may just say, I know how passionate you and the public advocate are about this, and I appreciate your comments. What made me comfortable with the amendment suggested by Dave is that in the second resolve, it clearly states that the board will utilize an investment consultant to assist the board in determining prudent steps to divest and exclude from our portfolio the securities issue, blah, blah, blah. So having divestment in that second resolve makes me more comfortable. And, I do, sort of want to acknowledge that this is a little bit of a, untreaded territory, because we would like to quickly issue an RFP, but an RFP, but in discussing how to do that, we realize that we don't really know what the questions are that we would want to put in to have investment consultants answer. It's not just, should we divest? What do you think? Like, we really want to dig deeper. So to Dave's point, having a little bit of broader language on this resolution, which is starting the process of an RFI and an RFP, I'm entirely comfortable with.
Other comments or discussion? Okay, so there's an amended motion on the table, including Dave Katzman's substitution. I will point out to anybody who is not comfortable with the amended motion that you do have the right to vote against the amended motion, and if the amended motion is not approved, then we can take up a different motion, if folks want to. Okay? So, motion on the table. Is everybody clear on the amendment to the motion that was circulated by the controller? Yeah. Okay. So all in favor of the motion as amended, please say aye.
Aye.
All opposed, please say nay.
Nay.
Any abstentions? Okay. The motion passes.
R5.
R5. All right. I believe that does conclude our public agenda for today. So a motion to adjourn would be in order.
I move to adjourn.
Moved and seconded. Thank you. Any discussion? All in favor of the motion to adjourn, Mike Haddad's voting with his feet. Please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Meeting is adjourned.
We're now in public session. I would ask for a motion to approve the resolution regarding New York City pension funds divestment and exclusion strategy for fossil fuel reserve owners.
Leo McGinnis for the UFA makes a motion to table this resolution.
UFOA, John Farina, we second that motion. We need more time to look into the divestment strategies.
Any objections? Hearing none, the motion carries.
I want for a table. Table.
Okay. Well, you still have to make a motion, can I table it or not?
For tabling, we usually don't need a motion.
Okay.
Now we move out of the public session.
So you have to read into the record the two votes?
Two votes.
You have to read in the record the two votes.
No, I have to read the two votes.
Oh, okay.
During the executive session, the board discussed various investment matters, reviewed personnel decisions, and also made decisions about which candidates to hire. We now need a motion to move into the life insurance fund meeting.
So moved.
Second.
Any objections? Motion carries.
A roll call for the life insurance, as was the same for the previous meeting, but roll call for the city. Mayor's office, I'm sorry.
Jackie Gold for the mayor's office.
Thank you. For the controller.
Susanna Vickers.
Okay, and for Commissioner of Finance.
Jackie Gold for the commissioner of finance.
Okay, for the UFA, Mr. Gerard Fitzgerald.
Leroy McGinnis with Gerard Fitzgerald's proxy.
Mr. Leroy McGinnis.
Here.
Mr. Edward Brown.
John Kelly with Edward Brown's proxy.
And Mr. John Kelly.
Present.
And Mr. Thomas Bailey.
Here.
Mr. Jack Kelty for the
Here.
UFOA. For the UFOA, Mr. John Farina.
Here.
UFOA, Mr. Paul Maddox.
Here.
And for the fire commissioner, Daniel Nigro.
Terrell Brown.
We have a quorum.
So I would like a motion for the board to direct the fire life insurance fund and ask BAM to work with a consultant, New England pension consultants, and actuaries to review the asset allocation for the fire insurance fund and bring their findings back to the board.
John Farina for the UFOA, so moved.
Leroy McGinnis for the UFA, second.
Any objections? Motion carries.
Motion to adjourn.
Second.
All in favor?
Aye.
Meeting is adjourned.